Giving good moves today is also HDFC Bank on the back of good set of quarter 4 numbers and bullish brokerage note coming in there. Now we do see the NIMs expansion and loan book growth that augurs very well for the company. In fact, let's look at the numbers then. We had the NIIs that saw an uptick of 10%, 10.28% on a year-on-year basis. The PPOP, however, were down 9% on a year-on-year basis, but the PAT saw a growth of more than 6.5% on a year-on-year basis. The GNPAs also, improved and they declined by 9 basis points on a sequential basis, and so did the NNPAs that improved by 3 basis points on a quarter-on-quarter basis. Now, also we had the deposit rate that went up by 14% on a year-on-year basis, and the board has also proposed a dividend of 22 rupees per share. We had Nomura that came out with a note. They're maintaining a buy on the counter with a target price of 2,140 rupees. They've also increased the target price, so an upgrade coming in from Nomura. They feel that the performance has been quite strong, and they have increased the FY26 and FY25 loan growth estimates to 11 and 12% on a year-on-year basis. IFL also maintaining a buy call with the target price of 2,160, and we also have Nuvama that's come out with a positive brokerage note on HDFC. On the back of that, HDFC is in focus today.
All right, so definitely great moves on HDFC, but with this, let's also go across and listen in what the management has to say.
Credit deposit ratio has been brought down from the highs at the time of merger, which was at about 110%, to around 96% as of March 2025. Our deposits have grown faster than the system, and so has it grown faster than our loans as well. Next year, in line with what we had committed, the adjustment in CD ratio will not be so steep, supporting the loan growth for the bank, but it will be on a downward path.
You saw the NIM for us over the last 12 months, if you see, operated in a very narrow band. And there are two things going on in the cost of funds to be stable there. One is the borrowing mix has come down during this time period. Whatever is on the page there, you see that the borrowing mix in the first of the time period, December 23, was 21%. And then from then on, last March, it was 18%, and now it is 14% borrowing mix. So that's one of the tailwind that contributed as a positive item to the cost of funds. Then there is a headwind in the cost of funds we have seen is the customer preference towards time deposit.